The Federal Reserve Bank recently adjusted its approach to inflation and interest rates, and new data shows that inflation is decreasing faster than anticipated. June the 12th turned out to be a significant day for financial updates, as it's rare for announcements about FED and inflation to coincide. Chairman Jerome Powell mentioned for the first time since the pandemic began that there has been some modest improvement in controlling inflation. Previously, Powell consistently stated the need for more progress on this front. He acknowledged early signs of this improvement, indicating that inflation is beginning to slow. However, a slowdown in inflation doesn't mean prices are dropping. It simply means that they're not increasing as quickly as before. Over the years, the Federal Reserve has implemented two main strategies to tackle inflation. Firstly, they've significantly increased interest rates. Secondly, they engage in what's known as quantitative tightening. It involves reducing the size of the bank's balance sheet. This action helps control the amount of money flowing through the economy. Between 2020 and 2021, the U.S. government spent trillions of dollars it didn't have on various economic relief measures, including stimulus checks, unemployment benefits, PPP loans, and business grants. The government borrowed money, largely from the Federal Reserve, in order to fund this spending. Just so you know, despite its name, the Federal Reserve isn't federal, it's an independent entity. It isn't a reserve because it doesn't store cash reserves, and it's not a typical bank because individuals can't open accounts or make deposits there. However, the Federal Reserve can create money electronically. This is how it was able to lend such a vast amount of money to the U.S. government. This borrowing substantially increased the size of the Federal Reserve's balance sheet, which now includes these loans to the government. The Federal Reserve has been trying to reduce its balance sheet by selling off these loans to combat inflation, a process that is gradual. The Federal Reserve has also raised interest rates considerably. This directly affects the public as it makes borrowing more expensive. For example, mortgages and car loans cost more now in terms of interest compared to a few years ago. This rise in interest rates is part of the efforts to curb inflation and stabilize the economy. Many people, especially financial institutions on Wall Street, are keenly watching for any signs that the Federal Reserve might start cutting interest rates to stimulate economic growth. If you've been following the financial news and market updates, you might notice that the economy appears somewhat puzzling. On one hand, there's a reported 4% unemployment rate, which is among the lowest historically. Many companies are still reporting record revenues and profits. Given these indicators, it's not immediately clear why there's a need for further economic stimulation. However, from an investor's perspective, the desire is always for investments to increase in value. This has led to significant pressure, including political influence, on the Federal Reserve to reduce interest rates. Lower interest rates make borrowing cheaper, which can stimulate spending and, by extension, boost the economy. The downside is this can lead to inflation, but some argue that the economic boost is worth the risk of increased inflation. There's been a lot of anticipation among traders and financial institutions regarding potential cuts to interest rates by the Federal Reserve. Jerome Powell, the chair of the Federal Reserve, recently provided some clarity on this topic. Initially, there were expectations that the Federal Reserve might cut interest rates as many as 6 times in 2024. These expectations have since been adjusted, with forecasts now suggesting maybe 1 or 2 cuts, likely leaning towards just 1. This shows a major shift in expectations regarding the Federal Reserve's approach to interest rate cuts. For those wondering when the Federal Reserve might lower interest rates, the exact timing remains uncertain, but recent insights from Powell have shed some light on the likely direction of 2024. Powell mentioned that the Federal Reserve might increase the planned interest rate cuts in 2025 from 3 to 4. This update shows that they're continually adjusting their economic strategies, keeping in mind that inflation, often called transitory, remains a key topic in financial predictions. It's smart to be cautious with these forecasts, whether they come from the Federal Reserve, government sources, or even casual commentators. Remember, predictions can change, as seen with the reduced expectations for rate cuts in 2024. New information on inflation shows it's lower than expected at 3.3%, just a bit under the 3.4% people thought it would be. This news is exciting because it shows inflation is slowing down, getting closer to the Federal Reserve's goal of 2%. This is important because if inflation keeps falling, the Federal Reserve might reduce interest rates, which could help boost the economy. The highest inflation rates are currently seen in car insurance and housing costs. If you separate the housing category into rentals and home ownership, these become the top 3 areas impacted by inflation along with car insurance. Conversely, the lowest inflation rates or even decreases in prices are found in less essential items. The biggest drops in prices are in rental car services, toys, and used vehicles. These reductions help balance the overall inflation figure, but they might not affect everyone's daily budget because not all individuals need to rent cars or buy toys regularly. However, nearly everyone needs some form of housing and car insurance, making these expenses unavoidable for most people. These necessary costs are rising, and when combined with increasing grocery prices, they significantly strain budgets. Even though the overall inflation rate might look balanced due to cheaper prices in less critical areas, the reality for many is a challenging financial situation, especially for those considering buying a used car, which is one of the few areas where prices have dropped. So what does this all mean? There are a few key points you need to focus on. First, it's crucial not to get swept up in the emotional reactions that often follow announcements from the Federal Reserve or new inflation reports. The market tends to either soar or plummet based on these updates, largely due to emotional responses to the headlines. However, real financial gains are seldom made through such reactions. True profitability comes from understanding and following long-term trends in the underlying movements in the markets. The first step for anyone financially savvy is to look past the emotional noise and focus on these broader economic trends. For example, interest rates have a wide-reaching impact on the economy. They don't just influence the cost of buying a home, they also significantly affect corporations and commercial landlords. Unlike residential buyers who can secure 30-year fixed-rate mortgages, many big businesses and commercial property owners deal with millions or even billions of dollars in debt with rates that are subject to change. As we move into the latter part of 2024 and into 2025 and 2026, these stakeholders are particularly attentive to what the Federal Reserve does. This is because any adjustment in interest rates can drastically alter their financial obligations, from maintaining a manageable 2% interest on their loans to potentially shouldering a much steeper 7%. This potential shift is why so many large-scale investors and business owners keep a close eye on the Federal Reserve's policies. The rising interest rates are making a significant impact on many people's financial planning, especially regarding their monthly payments. For individuals and businesses dealing with large loans, such as commercial landlords and big corporations, any shift in interest rates can drastically affect the bottom line. This broader economic environment also affects the job market, which appears not to work equally for everyone. While some find opportunities, many feel underemployed. For instance, more than half of college graduates are in high school-level jobs a year after graduation, and even 10 years later, about 45% still find themselves in similar positions. This shows a disconnect many feel with the job market's ability to provide appropriate employment opportunities. You must understand these economic ups and downs because there are parts of your financial life you can control and others you can't. Being smart with your money is something you can control, and doing it right can either set you up for success or cause problems when time gets tough. The U.S. economy has always had its highs and lows, with recessions coming about every 10 years and prices of things like houses and stocks going up and down. Many people try to predict these downturns to avoid losses, but this is usually not successful and can lead to big losses. A better strategy is to be prepared for these downturns. This doesn't mean you should stop investing until things look bad. It means having a strong financial plan that works well, whether the economy is doing great or not so great. That's all we have for you today at Economy Obsession. Don't forget to like, share, and subscribe to our channel so that we can keep bringing you the latest economic updates.